Real estate, the economy, everything is so week to week right now. Just last week, woke up Monday morning to some great news, right? Rates dropped because of a ceasefire rumor. Tuesday, a tanker gets hit in the street, rates went back up. Wednesday, the Fed gets on a microphone, rates jump back and forth. Meanwhile, homes are still flying in Philadelphia, showing activity, huge jump, which I'm going to break down in a second. But looking at the real estate market is a full-time job, and that's what I'm here for. Depending on how closely you're following the Fed, the 10-year mortgage rates, the market, there is a chain reaction that connects everything, and that's what I want to break down in a clear matter for you guys. Because once you see how all the pieces line up, you're going to be a better informed seller, you're going to be a better informed buyer, or you're just going to be a better agent that can provide pinpoint guidance to your client. So that's what this video is all about. Stick with me. I'll make it fun. I'll make it make sense for you. For anyone that is new to these videos, my name is Andrew Pulini. I run the KW Empower office, the #1 KW office in the country, the #1 real estate brokerage in Philadelphia. Every week I put out content breaking down what's actually happening in this market, not the headline version, but what's really going on in the city of Philadelphia. I use data, no fluff, no filler. And by the end of this video, I want you to understand the full chain reaction from what's happening overseas to the number that you see on your phone when you check mortgage rates in the morning. So in a couple minutes, you're going to know exactly what to do with all of that information. So let's get into it. Let's start from the beginning. Let's look at the first piece, the first domino. Everything in the world starts in the Middle East right now. And we're going on month 6 that we've been in Iran. Let's remember that Iran has massive leverage in this battle. They have the Strait of Hormuz, where about 20% of the world's oil supply runs through it daily. And when conflict escalates, missiles, tankers get hit, blockades, the oil market reacts immediately. Oil prices go up. And when that happens, energy costs go up across the entire economy. Gas, diesel, shipping, manufacturing, everything. That keeps inflation from truly cooling down. Piece 2, now let's look at the Federal Reserve. The Federal Reserve's whole job right now is to get inflation back to their 2% target and keep it there. But when oil prices are elevated because of the ongoing conflict, inflation stays stubborn. The Fed can't justify cutting rates when inflation isn't cooperating. In fact, the most hawkish members of the Fed, the ones that are worried most about inflation, are actively talking about raising rates, not cutting them. So that's why your mortgage rate for potential buyers out there is sitting around 6.8% right now. The Federal Reserve's position on inflation gets priced into the bond market, specifically the 10-year yield. So when the Fed sounds hawkish, as they do right now, which means they're pessimistic about the market, when yields go up, mortgage rates follow, and because mortgage rates are directly tied to what the 10-year Treasury is doing. So the full chain looks like this. When conflict escalates in the Middle East, oil prices rise, inflation stays hot, the Fed stays hawkish, bond yields move, and mortgage rates react. That's the domino effect, and it can all happen pretty quickly. And I want to touch on one thing about the Federal Reserve, what's actually happening with them right now. So when most people talk about the Federal Reserve, they usually think about the Fed chair. Right now, that's Kevin Warsh. It used to be Jerome Powell until earlier this year. Warsh was appointed by the president, and the president has publicly stated that he wants rates to go down. Here's the thing though, the Fed chair doesn't set policy. Policy gets set by the Federal Open Market Committee, which is made up of multiple members, each with their own view of where rates should go. The bond market, which essentially dictates where rates are going, they're not listening to Warsh. The bond market is listening to Beth Hammack, who is the president of the Cleveland Federal Reserve. Hammack believes that the economy is at full employment right now, which means everybody that wants a job has a job, but she also thinks that inflation hasn't been tamed enough. So right now she is pushing for rate hikes, not cuts. And she's also brought other members of the Federal Reserve onto her side. So when she speaks, yields are moving. When she signals her next move, traders are positioning accordingly. So overall, we were actually talking about this at the dinner table last night, but Beth is really the reason that interest rates are pushing 7 instead of being below 6.5 right now. What's funny is that Warsh might actually be the least influential person in that room, even though he's the Fed chair. Nobody at the Fed really trusts him right now because for years prior to him being appointed, he always talked pretty negatively about the Fed and their system. So now he's in the room and everybody's like, who is this guy? Why is he here? I think it deserves its own reality show. So what can change the direction of rates? Two things. One, the conflict could end. That would remove oil pressure, which would give inflation room to cool, which changes the calculus for the Fed. Two, we get softening in the jobs data report. That would be unemployment ticking up, jobless claims rising, hiring being slowed down. If these two things can happen, even Hammock will have to change her tune, and that's when rates can actually start to come down. But here's some good news, okay? Mortgage spreads are still saving the day right now. Rates, given the state of the world, conflicts, they really could be much higher right now. The spread is almost like the shock on a car. And right now, at least for mortgage rates, they're very strong. Technically speaking, though, the spread is the gap between what the 10-year treasury yields and what lenders charge borrowers on a 30-year fixed mortgage. So back in 2023, it was over 300 basis points. Right now, we're at about half of that. And that's saving the day. So is 6.8% for a mortgage great? No. Is it survivable? Yes. Is it going to stay here forever? It won't. But understanding why it's here right now is the difference between making a panic decision and making a rational one. So understanding the data is super, super important for everybody. And now that we know why mortgage rates are moving right now, let's bring it home, literally. Home prices in Philadelphia last month, July 2026, the average was $293,000 compared to last year where we were at $275,000. So prices are still going up because demand is still very strong in the city of Philadelphia. Pending sales here locally in the city are up 5% compared to last year. Here's the wild number. Showing activity for the first weekend in August this year was 25% higher than where we were a year ago. 25%. Great homes are still getting multiple offers way above ask in desirable neighborhoods here in the city. So I don't always love the days on market stat because there are a ton of homes that are sitting there overpriced, which is weighing down the averages, but great homes priced right, they're going within a week. So if you're a buyer sitting there wondering what to do, I will tell you this. We can't control rates and we do not know the future of where they will be heading, but we do know where home prices are going. For example, on a $275,000 house that you were considering buying last year, you already lost $18,000 in appreciation waiting from 2025 to now. The perfect time really just depends on your situation. So I don't want to give generic advice on video, but let's just say that the Middle East conflict ends tomorrow and rates end up coming down. Every buyer, like yourself, will be out next weekend submitting offers. So the window that you thought you were waiting for will slam shut. And that's the irony of trying to time the market, is that the move that you're waiting for creates the exact environment that makes the move harder. So I wanted to make this video relatively short this week. Rates are up. The Fed is still very hawkish about the future, yet demand here in the city of Philadelphia is still extremely strong. So I know a lot of this stuff can feel overwhelming, but my job is to make sure people in this market, buyers, sellers, and the agents that serve them are making decisions based on what's actually happening and not just reading headlines on the news. The market is certainly week to week right now, but your life isn't. Your decisions about where to live, what to buy, when to sell, that deserves a longer view than whatever came across your phone this morning. If this video helped you make any sense of this, hit the like button. It genuinely helps more people find this content. And if you want to see more videos like this, market breakdowns, data deep dives, and what's actually happening here in the city of Philadelphia, then do me a favor and hit that subscribe button. I put videos out like this every single week. Also, if you have a specific question about your situation, your neighborhood, whether now is a good time for you, then drop it in the comments because I read every single one of them and I'll either answer it directly or I'll turn the question into its own video. That's all I got for today. Let's see what happens this week and I'll be back on later to break down everything for you guys.